Okay, so the Fed raised the federal funds rate 0.25% yesterday. Here's what we think that means. So before the Silicon Valley Bank crisis, the market was assuming that the Fed was going to raise 50 basis points. And then a couple weeks ago, everything happened with Silicon Valley, Signature Bank, some of the regional banks around the country. After that, there was some dialogue about perhaps the Fed was going to raise 0 now. So they went from 50 all the way to 0, and they ended up raising 0.25%. The Fed Chair Jerome Powell said that they continued to raise rates because, remember, the Fed was trying to fight inflation as they were raising rates. So that's really, their eye is still on that ball. So they raised it 0.25% to still try to keep inflation capped. The problem is the aggressive raising of rates over the last 12 months is what helped facilitate the banking issue with Silicon Valley and Signature Bank and some of the other banks. If they continue to raise rates like raising 0.25%, it doesn't solve any of those issues that those current banks have. The Federal Reserve Chair Jerome Powell and the Secretary of Treasury Janet Yellen have basically insinuated, well, we're going to backstop the banking system and we're not going to let this issue that happened with Silicon Valley Bank or Signature Bank become a systemic issue, even though there are some regional banks that are still at risk of going under. As you can imagine, they want to try to avoid a full-scale banking crisis where you have people pulling all of their money out of these small regional banks and putting them all into the big institutional banks. The Fed chair commented that they're likely not going to be raising rates as we head further into the year, but they're also not going to be cutting rates as we head further into the year. So we can be fairly safe in assuming that mortgage rates likely aren't going to be moving significantly down, at least in the short term, over the next 3 to 4 months. The bond market, which actually controls mortgage rates, responded favorably after the Fed announced their raise of 0.25%. So we actually saw mortgage rates get a little bit better yesterday afternoon, and today we've seen mortgage rates continue to improve. Basically saying that the bond traders that trade in and out of that market don't really believe what the Fed is selling, and so we saw bond prices rally, which drove mortgage rates down over the past 24 hours. To recap, the Fed raised rates 0.25%, which the market was basically predicting. It doesn't really help any of the smaller regional banks in the liquidity crisis that was caused by the Fed raising rates so aggressively, but they also commented that they're basically going to backstop these smaller banks to avoid a large-scale banking problem. The mortgage market actually responded favorably to the Fed's announcement and their comments because it's unlikely that rates are going to go up or the Fed's going to raise throughout the next few months. It's going to take a few months for all these moves to kind of make their way through the system and to play out. So we're really focused on October, November of this year to see really how mortgage rates are going to trend over the next year. So we'll continue to keep our eye on it, keep you posted.